Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. So I just let you move on to the next disclaimer. Our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way and write them in the box, and we'll try and answer those as best we can. Anything that we are looking at or that you're looking at as well, fundamental or technicals, then please do ask any questions. And as I say, we'll hope to ask them along the way, or at least after the webinar finishes. Okay, it's Wednesday, July the 2nd, just after 11 a.m. in London. So let's get to it. We'll just check out how markets are trading currently. We'll then look at some of these current themes, essentially dollar lows and stock highs, and a few reasons about especially the stock highs that we've been seeing. Then we'll just quickly review the main risk events that we have seen. Inflation data really, and some PMI data as well last week. Before then, a big preview of the non-farm payroll report out tomorrow. Of course, it's Independence Day on Friday, so that release is on Thursday tomorrow. And we get some ISM data as well, having had the manufacturing numbers on Tuesday, just yesterday. Okay, so firstly, we'll just check out how markets are trading currently. The dollar actually has a bid for once today. It's had 9 consecutive days of selling. We haven't seen that for many, many years. Yes, essentially, I'll get to this chart first of all, which essentially shows you how bad a period it has been for the dollar. If we get straight into this, actually, we're obviously on the halfway line of the year. And while Trump's return to power in January was always going to obviously ruffle markets, really, even I guess the most hardened market watcher really has been shocked by the volatility. So potentially it's a great rotation, but the main evidence, of course, is that the king dollar is having its worst start to a year since the era of free floating currencies that began in the early 1970s. Many reasons for this, of course. The weak undertone in the world's reserve currency has persisted through this year so far. Risks around, of course, trade, around fiscal policy, those certainly under the microscope at the moment. Momentum, of course, was firmly bearish after 5 months of losing, basically a 5-month losing streak already, and we've just extended that for another month, so 6 months of down months. We haven't seen that since August 2017. We've also had these ongoing attacks on the Fed's leadership and independence that has especially undermined the appeal of the greenback and US assets more broadly for international investors. They basically find themselves overexposed to US highly valued assets and then also underhedged on the weakening dollar. Not a good look for the dollar at the moment, and certainly down in the dumps with multi-year lows. Interesting, just more immediately, data yesterday, well, that pointed towards higher prices and a resilient labor market, essentially, and that's probably not the case for any imminent Fed action, certainly in its Fed FOMC meeting at the end of July, 30th of July, that is. Still some time to go, and obviously we have the non-farm payroll report tomorrow, but essentially that would only be one report, and you kind of think that 20%, 1 in 5 chance of a rate cut in that meeting is, potentially an interesting one. We'd really have to get a rollover of a lot of data to probably get that cut. That means markets really have leaned on, well, too far on the dovish side, really, and you kind of think there should be some support for the dollar, potentially as well, if inflation picks up on the tariff tensions. They have returned to the spotlight, just for your guide as well. President Trump actually overnight signaled no extension of the reciprocal tariffs beyond the 9th of July. But markets really are wary of taking this at face value, of course, with the tacos trade evident, and given, of course, those recent reversals. I guess the prevailing view now may be that global tariff threats peak before another last minute reprieve. So just watch out for that. And then this time markets may focus more on bilateral risks for countries like Japan, Canada, Japan certainly in the crosshairs of Trump at the moment, or the EU as well. But then that said, of course, even targeted tariffs have weighed on the dollar in the past, and setting aside, of course, US data risks into that July 9 deadline next week remain probably skewed to the downside. So competing drivers here for the greenback as it struggles at multi-year lows. We'll look at the charts shortly, actually, when we look at NFP. But otherwise, that other theme that we wanted to show you was, of course, stocks and their highs. If I just pull up a chart of the S&P 500, which is here, and you can just see the previous high at 61.47. This is the S&P, and you've got the interesting, the 50-day just crossing above the 200-day, that blue line crossing above the black line, which is well, a golden cross, so a bullish indicator at these highs. So that's interesting, even though we're overbought on the RSI. Yeah, just a couple of technicals there, but the rally we've seen been quite incredible from that low at 48.35 at the start of April after Liberation Day. A number of factors fueling that rally, of course, the geopolitical relief really, since Middle East tensions have eased significantly after the Trump brokered peace agreement, really peace ceasefire, if you like, between Iran and Israel. We've had trade optimism return, really, trade deals between possibly EU and China looking more plausible now. Certainly that sort of volume has turned up as we go into that July 9 deadline. We've talked about that. Fed rate cut expectations have ratcheted higher actually in the last couple of weeks only. And that is a sweet spot for risk markets, really, if there's a soft landing scenario, but also then the Fed are easing into that. That means the economy not falling into recession, and as I say, a sweet spot for risk assets. We've also had policy relief, well, from Section 899. That's been removed, actually. So markets cheering that decision. Is that, just for your guide, is a so-called revenge tax from the One Big Beautiful Bill, which got passed, of course, but still needs to go to the House. But generally is acknowledged that it will get passed in the next few weeks and months. But that clause had raised concerns among foreign investors about basically punitive US tax treatment. Basically, its removal eases fear of capital flight and supports really continued inflows into US assets, that is. So yeah, just a number of reasons behind the rally, of course. Interesting when we look at it in more depth, the breadth really is interesting now. Slightly improved, really. If you look at year-to-date performance, that suggests participation is widening beyond just those sort of top mega cap tech names, if you like. Sectors like industrials, communication services, utilities, and financials all outperforming actually on the year. So it kind of indicates not just a tech story. Consumer staples and materials, they're also in positive territory, adding to that sort of case for a slightly more diversified rally. But then you have to look at some pockets which are still lagging. So consumer discretionary stocks, they've fallen over 3% year to date. Healthcare, energy also underperforming the broader market. So that divergence does raise, well, the possibility that while, as I've just said, the rally is broadening, it's not yet all encompassing. Going forward, then obviously the tax bill kind of out of the equation now, but it does, of course, add trillions to the federal debt. So should be watched really for sort of the short-term positivity against the long-term nature of rising yields. We also got obviously trade deals coming up to that deadline and beyond. the tariff expectation is 10%, of course, at the moment. So anything above that would be detrimental to risk sentiment. And then we've also got the Q2 earnings season coming up soon. Expected only EPS of 2.6% year on year in Q2. That's much lower than the Q1 15.1% EPS that we did see. So just watch out for earnings, of course, as well, and their guidance from CEOs. And the geopolitics are obviously underpinning or bubbling under, really. And then we've got obviously the issues around Fed independence, but also then tax cuts and deregulation potentially happening to boost sentiment, along with, of course, watching data. So that is the equity rally that we're talking about. The S&P, you can just see up to 6,200, probably round numbers, good targets for bulls. You've got a previous high at 61.47, and then really the sort of 6,000 level as support, you would think. For the Nasdaq, similarly, made fresh highs. Intraday high at 22,721, closing at 22,679. You can see there, previous high, all the twos we've got. So that may offer some support. And then you've got sort of just below 22,000, that support where we sort of consolidated those recent gains. Again, blue line crossing the black line, so a golden cross with a 50-day just below 21,000. And that's the nearest fib level, although we probably need to adjust that to the recent high again now. The Dow's just lagging the tech indices really, and the S&P, of course, but a decent run yesterday, just moving into overbought territory, but a divergence really between tech, which was lagging yesterday, and some of the defensives doing slightly better. You can see that up 0.91% yesterday, the Dow, and heading towards, which is what we said earlier, or in the last few weeks, that all-time high at just above 45,000. 50-day not anywhere near the 200-day yet, and you've got support probably around that initial fib level 43,247, sorry, on the Dow. Okay, let's go now to just most recent big risk events worth reviewing. Firstly, PCE data, that's the Fed's favored inflation gauge. That rose 0.2% above the 0.1. And the year-on-year core, this is rose to 2.7 above the 2.6 forecast, while the prior was revised up. For the headline numbers, they were in line, actually 0.1% month on month, matching the prior, and year-on-year rising 2.3, accelerating from 2.2. So hotter than expected, really. PCE data, core especially worth watching, but it is clearly remaining well sticky and above the 2% Fed target around these levels. There are concerns, of course, ahead of the impact of tariffs potentially boosting price pressures, which is a big issue, although I know that many now are siding with what we've been saying over the last few months, actually, that they could look at this as just as a one-off price impulse of price pressure and look through that towards any growth issues. For what it's worth, Fed Chair Powell, he said they would expect to see meaningful tariff inflation effects in June, July, and August. Obviously, if they don't see that, that would lead to cutting earlier. And of course, then some on the Fed. Only a couple of officials, Waller and Bauman, both Trump appointees, really, they have suggested cutting rates as early as July, but that is not the consensus on the FOMC. And the view there really is that they'll stick to their wait and see stance. Obviously, as well, there's not really a deteriorating labour market as yet, and obviously we get non-farm payroll tomorrow, but obviously with sticky inflation above the Fed's target, and as I say, that more cautious approach is probably likely going forward. So that's the PCE data and the chart there just for your guide. We did hear from Fed Chair Powell yesterday, actually, I should stress that, at this ECB forum at Sintra in Portugal, along with quite a few other central bank heads. He basically refused Payrolls to rule out anything in regards to the July meeting, but he said he can't say if July is too soon to cut rates, and it wouldn't take any meeting. He wouldn't take any meeting off the table, but he then repeated the data dependence approach. He said the US economy is in a good position, pretty good position. Inflation has come down close to target, but not just there yet, and the economy is healthy overall. On tariffs, for your guide, he noted they've not seen any effect yet, but expect higher readings over the summer. So he was really non-committal, you have to say, and he's not really lined up a rate cut in July. Aside from then Waller and Bauman, those two dovish outliers, really, there's nothing really pointing to a July reduction. So that was the takeaway from most recent events. If we just go to Eurozone inflation data now, and we'll just pull up the chart, actually, euro dollar chart, that is. Let me just grab that chart, which is here. So yes, Eurozone inflation data. Well, the headline ticked up to 2%, so above the 1.9 on higher energy costs, but the core remains stable at 2.3. Services inflation, always key, experienced barely any bounce back actually after the unusually low reading in May. That ticked up just 1/10 higher to 3.3%. So overall, well, the domestic inflation environment expected to stay benign going forward. Inflationary pressures have clearly weakened as wage growth is coming down, and that should trend around 3% at the end of the year, which is kind of consistent with inflation at 2%, that ECB target, of course. And with economic performance remaining sluggish, that does keep the door open for a rate cut sometime in autumn. Markets got the first one fully priced in December, so just watch out for data going forward, of course, whether that's brought forward or not. So that's the inflation data. We also had PMIs, as I say, they basically came in slightly below expectations, reflecting ongoing economic stagnation, really adding to that possible rate cut bet for one more by the end of the year. Yeah, the PMIs, well, the composite stuck above 50 actually, but still signals little to no growth, 50.2. Services did rise to 50.0 actually from 49.9. And manufacturing unchanged and still below 50. Price pressures did remain muted, and obviously then we have the rising euro here, which is an issue and disinflationary, of course, for prices going forward, and the ECB will be very mindful of that. You can just see, yeah, 118.29, that recent high from yesterday. We probably need to go back to the monthly. You can see the 200-month moving average, that black line's just around 120. Interesting, I think we had some De Guindos, the ECB official, yesterday talking about 120 as an okay level, but anything above that would get complicated. So potentially as we rise into that, if we do, then that'll be interesting. And you can just see these consecutive months of gains from February, March, April, May, June. Which hasn't been seen in quite some time, I think since 2017, you can see there. On the monthly, that's the weekly. So 120 is a key target, you would think, for bulls. Otherwise, you've probably got highs around 119.09 there, as well as initial resistance to this move higher. We are overbought, not as overbought probably as we have been previously. That was around 73 for the daily RSI, so just watch out for that. Okay, let's move on now to finally NFP. Of course, non-farm payrolls out tomorrow, as I said, and we'll look at some of the ISM data came out yesterday and also out Thursday. Firstly, here's a graphic with all the main numbers. So as I say, make sure you don't forget, not on Friday. This is released tomorrow due to Independence Day in the US. Numbers really, 113 I think is the number at the moment. It might have ticked up higher after a few bits of data like the jolts and other data this week. So 113 at the moment, consensus expectation for the headline. Previous was 139, but you have to remember 95,000 of May's gains were netted out by revisions to the prior 2 months. So that left a net change of just 44,000. For your guide, 3-month average, that's 135, 6-month average, actually 157, and 12-month 144. Unemployment rate, that's expected at 4.3%, so a tick higher than previously. And again, for your guide, the most recent FOMC forecast made in June was for unemployment to rise to 4.5% by the end of the year. Earnings, wage growth, that's expected to cool 0.1 of 0.3% in June, while average work week hours is seen unchanged at 34.3 hours. So increasingly, the US labor market is looking as though it is stalling out and susceptible to downside risks. Over the remainder of 2025, I think most economists think weak growth in employment is expected to see the jobless rate trend higher. That is essentially because of lead indicators like business surveys, job vacancy numbers, and rising jobless claims suggest that through sort of July, September, that's a crucial period, and we could see much softer data. Just on the jolts, though, of course, we did get that data out yesterday, and well, quits rates are up, job openings are up, but that generally means it's a fairly decent labor market going forward. Regarding the Fed on, well, we've already been through Powell's most recent comments, really, and not much to say on the labor market. As I said, Powell said it, he thinks it still remains solid, and he cited strong job creation and labor force participation. No signs of continued resilience, actually, at the most recent Fed meeting. Of course, we have to be wary of Donald Trump, and any decent jobs data will probably be pounced on by him as an argument why the Fed should be in an easing cycle already, ramping up his recent criticism. And of course, then any downside surprise will likely be jumped on him as well as an argument as to why the Fed should be cutting rates anyway. So expect a lot of noise out of that after the number. For your guide then, Fed pricing, as I said, has ramped up quite a fair amount in the last couple of weeks. There's around a 20% chance, I believe, of a July 25 basis point rate cut. Remember, the July meeting's on the 30th, so quite a few weeks before that. And then we have around 65 basis points in total priced in for this year. That means there is around well, I've put over a 50%, but it with 65 basis points, there's a 60% probability then of a third 25 basis point rate cut by the end of the year. And that's what obviously has hit the dollar as well. If we just pull up the DXY chart then. You can just see I kept in this bear channel, so series of low lows, lower highs. We got up to the 50-day moving average and that long-term low at 99.57. The 50-day, which has capped the upside over a number of occasions over this year, that's now at 99.16. We're just falling now through that recent low anyway from earlier in June at 97.60, consecutive days of selling. That hasn't been seen in many months. I just want to pull up the monthly chart here because I pulled in a long-term trend line, support line, if you like, from going back to 2011, tapped or was support as well in 2021, and you can just see we tapped that earlier. Well, yesterday, that dotted line there, and we've just found support at that line. We shall see. It's a very long-term support line, but only been tapped once. Yes, just watch out for that. Otherwise, yeah, there's not much support really going down to sort of 96. And support, I'm just checking around here, which is, yeah, around 96. That's support from 2022 and late 2021. So that's the DXY chart. Not looking great. Just for your guide then, other bits of data, we have that ISM manufacturing data, the PMI data for June, that rose to 49, just above the 48.8 expected, so still remains in contractionary territory. Prices paid, though, they unexpectedly lifted to 69.7, while new orders and employment fell, actually, respectively. That was that data. We do get non-manufacturing, so services ISM out on Thursday. Tomorrow, that's forecast to rise back into expansionary territory of just above 50 at 50.3 after its brief dip below to 49.9. Services activity has actually remained above 50 since July 2024. New orders, watch out for those, and prices, the prices components, they will be in focus, of course, due to uncertainty around tariffs and the inflation and economic outlook. Just for today as well, we do get employment data, the ADP payrolls. That's really not a great predictor for the official non-farm payrolls data tomorrow. But certainly with the employment data central really to the dovish Fed theme, if you like, then market sensitivity could be elevated. I take it with a pinch of salt, really, that kind of idea, because there'll be a knee-jerk reaction, but then we're waiting really for the big numbers tomorrow. Consensus, just for your guide for your ADP, is for a rebound to 96,000 from 37,000. Okay, I'm just checking if we have any questions. We don't have any questions at the moment, so yeah, really do appreciate you being on the call and tuning in. We are back same time in a few weeks' time. Take care out there. Lots to look out for, especially with this July 9 deadline, non-farm payroll tomorrow. So digesting that obviously over the holiday shortened week, really, before we then get into that tariff deadline and beyond. We'll speak to you in a few weeks' time. Good luck and take care.